Good evening and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending January 5th, 2024. And I'm going to title this week's video A Mixed Employment Report and Poor ISM Figures Ring in the New Year. And we're going to take a look at this because the Fed policy has pivoted, and that's kind of built in to a degree to what the market is trading at. But the big question is, will the economic data decelerate so much that you have a hard landing? And a hard landing really is about a credit event. And I'll get to the charts here in a minute, but that's not at least the base case or what the market is expecting at this point, or starting to price in. They're not even starting to price that in. So we're going to look at that, but we'll start off with the economic data here. And the ISM Services Employment Index. This was the biggest shock of the week, and it came in at 43.3. Remember, the services side of the economy is about 2/3. Everyone talks about goods and our factories producing things, are people buying things? That shouldn't be the question you're asking yourself. That's a relatively small percentage of the overall economy. Services is really what our economy runs on. And so if the demand for services wanes, that is most of the demand in the underlying economy. And if employers are now laying off workers in nearly 2/3 of the economy, 3/4 of the economy, about 70% right in there, then that doesn't bode well for the future of employment and just economic trends in general. So that was the most surprising figure. The new orders that came in at 52.8, that wasn't too bad. Still positive. I mean, remember, anything above 50 is shrinkage. So when you see 43, that's major shrinkage. Let's zoom back out. We haven't had that since the COVID era, right? In the midst of the COVID shutdown, it was at 47, dipped all the way to 30 in April. That bounced back. You zoom all the way back to the financial crisis, and that bottomed into the 30s. So, it's not as bad, but what you can see is when this falls, you pretty much have a recession. So this was the first major signal to me that we could be heading into a recession. But it's one signal, it's one data point, and you have to look at them all in conjunction. Like I said, new orders that remained in growth territory. That was fine. The total ISM report back down to 50.6, still growing, but pretty much at neutral, right around the 50 mark. Now, the non-farm payrolls came out on Friday. That was at 216, better than expected. But underneath the hood, it was a mixed picture overall. You had average hourly earnings that did accelerate a little bit. That's positive in general for the labor market. Obviously, the Fed wants us to continue to see that decelerate. Employment rates stayed steady at about 3.7%. But a lot of that's because a lot of people left the workforce. Okay. And then total private hours, average hours worked down to 34.3, still the lowest of this cycle, the lowest level since the COVID shutdowns. And then if we get into durable goods orders, that did tick up month over month. This tends to be a noisy data set, but always interesting to watch. That's ex transportation, which is what you want to look at. And then the recession probability, that did perk up to about 63, near the highest level of the year. Not quite as, or I guess we're in 2024. So yeah, the highest level since May of last year. That's interesting. This is showing 2024. That's actually 2023. Let's see. All right. So how did that feed into market expectations? Because that's ultimately what moves markets, is what the market's pricing in. And 1 week ago, there was about a 17% chance of one rate cut, 82% chance of a pause. Now we're up to 94% chance of a pause. So what it says is the economic data so far this week wasn't bad enough to warrant a rate cut, at least so far. We have the inflation data coming in next week. That'll be interesting. But I think it's pretty locked in. There's no reason for them to cut this next month, at the end of this month. But March, you start getting out to March. Now there's a better than 50% chance, closer to a 2/3 chance, there will be a rate cut by March, which is pretty interesting, which is the market telling you that this economic data, this services employment index number is harbinger of weaker economic data to come. Now, remember, all last year, the market was kind of expecting a Fed pause, and we got more rate hikes in the summer. Okay, so just because the market is pricing in one thing doesn't mean that thing is going to actually happen. So that was the economic data, mixed overall with one pretty big worrying number. Now let's dig into the charts here. Let's look at the S&P. That was down on the week. I'll zoom to a weekly chart because sometimes it gets you a little more perspective. The first down week in, let's see, 3, 6, 7, 8, 9 weeks. We had 9 weeks, 9 positive weeks up on the S&P, and this is the first down week. Not a shock, into resistance, right? The all-time highs from the beginning of last year. Sorry, beginning of 2022. I have to get used to that, right? That it's a new year. Last year means a different thing. So not a shock to see that head down in the midst of that resistance. NYSE, same thing. This kind of had that lower high, first major lower high here, and we're back to those levels. And that is not, it's not shocking to see a bit of resistance there. Now, the bigger question is, what is happening in the credit markets? Because I've said many times, the only way you get a major pullback in equities is if you get some sort of a credit event. You can have a normal pullback like we had seasonally in the summer, and what you can see though is that we didn't get a breakdown. Think of this is the ratio of short-term junk to short-term treasuries. This was the banking crisis last spring, excuse me, and this pullback didn't make a new low. So what you had was a continued uptrend since that banking crisis. And this is a pullback. Naturally, you expect that. Once again, a little bit overbought, but we're not breaking the 50-day. Until we break that 50-day, I'm not going to think of this anything more than a modest pullback. And frankly, the 100-day, which is this green bar, that's the green line, that's going to be the 100-day. The red is the 50-day. So those will be the two major support levels. If you get below that, then you can start talking about maybe a potential for something broader. But right now, I just don't see it. Now, the VIX, that ticked up for most of the week, but closed pretty strongly down on Friday. So while it's in an uptrend, it's not really threatening a major breakout. So I wouldn't get ahead of yourself expecting some big drop, at least until option X. We have 2 weeks, next week and the week after. The week after is option X. Maybe after that, because of the way option markets work and gamma hedging and things like that, the fact that there's positive, we call it positive gamma, usually those sell-offs are going to be contained, let's just say that, unless we turn into a negative gamma situation, which could happen after option X. Now, let's take a look at the MOVE index. It's kind of the volatility of the treasury market. That remains well subdued, not breaking out, consolidating. I'll be interested to see if we're going to stay above kind of this 110 level. That would be pretty much a consolidation period from that breakout in September and October. But overall, nothing to worry about on that front. Let's take a look at oil. Here's the USO. USO getting a bit of strength this week compared to the broader market. So something I'll be watching for is to see if that XLE and oil can tick up. There was some good relative strength in the oil market. So going in, last year was not a great year for oil. Not terrible. I think broader oil equities on average are down about 10%. One of the worst performing sectors of the year, but it's a volatile sector, and a negative 10% year is not terrible for that sector, because there easily could be a multi double-digit year this year. 20, 30, 40% would not shock me to see that out of the energy market, especially with the geopolitical situations that are happening abroad. Gold prices, those were down on the week, but still making a series of higher highs and higher lows. You have to look at these in context, and we remain in an uptrend. So I don't worry too much about that. Let's take a look at the dollar. I was using the UUP. You did have this. This is a tax situation that happened here in December. So you kind of have to shake that out. So we're slightly up from when that happened, but overall still below that sell-off. So we're still in a downtrend in the dollar is the long and short of it. And as long as that's happening, it's another reason why there's unlikely to be a major credit event and thus a major market sell-off. But I'll be watching for that to see if this gets any traction to the upside. Obviously, a weaker dollar is good for the commodity side of the market. What sectors did well this week? Industrials pulled back. Let me just pull up this. This is always a good chart to take a look at. Let's see how fast I can get this up. Oh, sometimes you have to sign in and then get to the data. Let me pull this over here. There we go. There we go. All right. There we go. Finally got it up. On a weekly basis, actually 1 month. That's what Morningstar has. So what you can see here, let's sort that by 1 month. You can see healthcare has had a good month. Financial services had a good month. Basic materials having a good month. Communication services of the growthier side of the market definitely having a better month. A lot has to do, I think, with the Verizon and AT&T, your traditional telecom names, as opposed to the Googles and Metas of the world. But that's having a good month. Industrials 4%. But what you can see is technology only up 0.5% over the last month. And that brings me to this. Growth to value. This continues to enter this downtrend, very similar to 2022. Does this look familiar? Look at this. Big breakdown, the first week of 2022, and we never looked back. And you had that trend going into 2022. See that downtrend? Remember, this is the growth to value, whether growth's outperforming or underperforming. If this is falling, it means value's outperforming. And you're getting a similar setup here as you did in 2022. And I think that is the likely path forward for 2024, is something very similar to 2022. Now, does that mean you have to have as bad of a negative year in equities as you did then? Probably not. But I think that rotation out of growth and into value is likely to continue. Take a look at the ARC. Look at this sell-off. These are called the Ponzi names, and these are not the names that you want to be in as we go through 2024. Anything that does not produce profit, does not produce cash flow, that's reliant on raising capital, which is increasingly more costly, is likely to struggle. So that is the trend as we enter 2024. So as I've been saying for the past few weeks, your general bias should be positive for equities, but more with an eye towards rotation into the value side of the market. I think that about does it. I appreciate you all tuning into this channel, liking and subscribing. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.